Lesson 25, the theta of an option. Here is what you will learn here. What is the theta of an option? An in-depth study on the theta. Theta is the passage of time. Previously, we have seen that option prices depend on both the current performance of the underlying and the expected future one. The latter, the expected future one, depends very much on the probabilities of the events, which in turn depend fundamentally on two parameters: how volatile the market is and how much time is available. Time is a key variable for defining the probability of events. Some numerical data to fix this. Between January 3, 2000 and December 31, 2013, Eni's share had an average daily price change of 0.03%, and in 70% of the days it moved within a range of minus 1.41% and plus 1.47%. This data emerged from a statistical analysis of daily returns given by the change in the price at the end of the day compared to the price at the end of the previous day. This basically means that investing money on any stock 7 times out of 10, you can't hope to earn more than a 1.47% a day, and you have to be prepared to suffer a loss up to minus 1.41%. What happens if we look at a longer time horizon? If we move to the 2-day horizon, the daily average of the prices changes rises to 0.06%, while in 70% of cases we can hope to get up to a 2.09%, but we must also be prepared for the risk of losing up to 2%. If we then move on to a 5-day time horizon, the average daily profit achievable is 0.14%, and 70% of the time you can earn up to 3.24%, but also lose up to 3.09%. All this means that the more time you have available, the more opportunities there are for increasing profits, but you also expose yourself to increasingly greater risks. If the distribution of returns were normal, then for each trading day we could superimpose on the price chart a normal curve rotated vertically and calculated on the expected returns on 1 day, 2 days, 3 days, and so on, up to any time horizon. In this way, it would always be clear before our eyes the probability of any price interval. What is clear from the graph on the previous slide is that the less time available, the lower the probability of all events, especially those that are more external than the average, in both directions. The more time passes, therefore, the more the quantification of the probability of the events is reduced in coherence with everything seen so far. It follows that if day after day market parameters do not change, the prices of the options, both call and put, are reduced due to the reduction of the probability of the events. A fundamental point here is that the hypothesis that all the other market parameters do not change, because in fact, as we will see in the graphs in next slides, the initial conditions of the system have very different impacts on the time decay of the options. In particular, the time decay is very different depending on the moneyness of the options, so that the shape of the curves over time according to the different situations can be significantly different. That is, we cannot observe curves of the same shape but different heights, but curves of different shapes and different heights. An important note, that theta measures the loss of value of an option from a day to another, so it is always negative, except for options very deep in the money, and this is just for purely mathematical reasons. It goes without saying that the transition from Friday to Monday impacts more on the price than at any other time of the week. So there are two ways to calculate theta, either on calendar days or working days. It is always good to know which of the two criteria is adopted by the platform in use. Theta of a call in calendar days. This is the theta of a call strike 22,000 points on the FTSE MIB index in front of different values of the underlying, given a risk-free interest rate 0.01%, a residual life 30 days, and implied volatility 25%, no dividends. The two curves represent the same phenomenon from two different perspectives. First, let's read here. The theta is how much the price of the option decreases as a result of the passage of a day. As we can see, the at the money option is the more reactive one. In negative terms, because every day that passes, the more the price, the premium of the option is eroded. But pay attention, it is interesting to note that at the money options suffer more than all the others the passage of time in absolute terms, the pink line, but less in relative terms, the blue line. Indeed, the pink line refers to the left y-axis, which is in points. The blue line refers to the right y-axis, referred to percentage variations in the price of the option. So, in absolute terms, the ATM call is the more reactive to the passage of time. But in relative terms, how much this decrease in the price of the option is related to the initial price of the option it tells that the at the money option is the less reactive one. Theta of a put, same. Theta of a put strike 22,000 points on the FTSE index in front of different values of the underlying, given a risk-free interest rate 0.01%, residual life 30 days, implied volatility 25%, no dividends. Once again, the at the money option is the one that reacts the most in absolute terms, but the one that reacts the less in relative terms. What happens to the theta of a call in respect with the volatility? This is the chart of the theta versus the volatility of a call strike 22,000 points on the FTSE index, given a risk-free interest rate 0.01%, a residual life 30 days, no dividends, implied volatility ranging between 10 to 30%. The lower the volatility value, the implied volatility, the lower the loss of the option due to the passage of time. The higher the implied volatility, the more significant the value loss of the option day after day. Theta of a call in respect with time to expiry. This could seem a contradiction in terms. We are measuring the effect of time in respect with time, but it is absolutely relevant. This is the chart of the theta in respect with different residual lives of a call strike 22,000 points, interest rate 0.01%, residual life ranging from 5 to 365 days, no dividends, implied volatility 25%. The longer the time to maturity, the less sharp is the reactivity of the price of the option to passing of time. The more you get close, the more dramatic it becomes, the loss of value day after day for the option. Time decay of calls in respect with the moneyness. This is another very interesting point of view. The time decay in function of the moneyness of a call option. Residual life from 365 days to 0, risk-free interest rate 0.01%, implied volatility 25%, no dividends. Look at the chart. The at the money option is the one marked with the brown line. Then we have the 5% in the money, the 5% out of the money, the 10% in the money, the 10% out of the money. So, according to this chart, it seems that more or less all the options reflect the passage of time in the same way. But in order to inspect the differences between the effects of the moneyness on the time decay of a call option, we have to focus on the very last days. And it's what is done in the next slide. Here we have the time decay in function of the moneyness of a call option, residual life from 35 days to 0, risk-free interest rate 0.01%, implied volatility 25%, no dividends. Look at the different behavior of the curves. The at the money option is the one that follows this parabolic trajectory, And as we can see, the maximum loss of value happens in the last days. With in-the-money and out-of-the-money options, it's the opposite. The highest loss of time value happens already up to 10 days before the maturity. When you get at 10 days from the maturity, especially with out of the money or with very out of the money or very in the money option, is that you could close the positions because the most part of the value of the option is already gone. And it could be risky to wait another 10 days just to get an incremental, very little profit on that option. Conclusions about time decay. Short selling of options, as we saw in lesson 10, is statistically the best performing strategy because it allows us to exploit the statistics to earn money. But as often happens, this discriminating factor between success and failure in trading strategies is not the operational setup, but rather the management of the existing positions. Well, if you short sell options to benefit from the time decay, it is good to know that if the options sold are near the money below maturity, then it is necessary to grit your teeth and move on, because the maximum benefit will take place in the very last few days. If, on the other hand, the options sold are out of the money in the last week of expiry, they have already produced over 90% of the profit potential, so they must be managed in order not to risk losing everything in the last few days. But take care, managing does not necessarily mean taking profit. Since closing unexpired positions means paying something, indeed, in many situations it is worth using that same money that should be spent in closing to neutralize the risk of the positions rather than closing them, turning them into other positions zero risk. This is a chance given only by options. These are operations that can be done thanks to the options. You just need to know how to move in any situation. We'll talk about it again later when we will look at non-directional strategies and ways to manage them. So far that's all. Thank you for your attention.